You know that feeling when a tax return starts out looking like one thing and then quietly it turns into something much bigger? In this case, one Schedule C shows about 95,000 of reported expenses, and then a second Schedule C shows up and suddenly the total is roughly $183,000. Same year, same household, same general orbit of projects, just a lot more deduction. That's an increase of about $88,000. And when the tax court finally weighed in one of those additions, the allowed amount landed at zero, with around $88,000 disallowed for that side venture. That's not a budgeting issue, that's an intent issue, and the court had a name for how it ended. The mulching business deductions didn't survive. I'm Alex Dvorkin. I'm a certified public accountant in the state of California, and if you like this kind of story-driven breakdown, please like this video and subscribe to this channel. This channel reviews and analyzes U.S. tax court cases to understand how U.S. tax law works. In this video, we cover the tax court decision in the case of James Sullivan and Colleen Sullivan versus Commissioner of Internal Revenue, decided on February 5th, 2026. This opinion is about two people the judge described as intellectually curious, hardworking, and generally credible on the stand. People who didn't go to college but spent decades building skills the hard way. The court said it found much of their testimony plausible, and it even described them as presenting a wholesome profile. That tone matters because the IRS wasn't just fighting over receipts here. The big fight at trial was whether several activities were really pursued for profit or whether they were the kind of lifestyle projects activities that can look like a business on paper while functioning like something else in real life. The backdrop starts long before the year is under audit. The taxpayer married in 1980, moved around the country, and repeatedly did major home construction work, sometimes building, sometimes remodeling, often managing subcontractors, doing design work, and even operating heavy machinery. One early home in Minnesota was sold for a profit when they moved to Montana, while the Montana home later sold at a loss when they moved again. Years later in Massachusetts, they bought a historic home in despair, did major renovations, and sold it in 2018 for about $1,350,000. Which the court noted was about $350,000 more than what they originally paid. That long history becomes important because the court later has to decide whether their main land development push looks like a commercial venture or more like the next chapter in a lifestyle pattern they've always enjoyed. Meanwhile, the main wage engine during the audit years was the husband executive level work in the broadcast technology and advertising world. The opinion lays out his role and explains that his compensation was partly commission-based and that in some years he out-earned the company's chief executive officer. During the years at issue, the wages the court lists are about $356,000 in 2017, roughly $178,000 for 2018, and around $227,000 for 2019. The wife, the court notes, did not work outside the home during those years, so the financial structure is clear: big wages plus multiple projects generating substantial losses on Schedule C. Enter the Central Umbrella, a single-member limited liability company formed around 1995. Over the decades, this entity had multiple incarnations. Early on, it tried to build trading software and gave up after 18 unprofitable months. Later, it was revived to invest in a music project, with roughly $30,000 of reported expenses tied to an album, still no profit. Then, around 2013 or 2014, it pivoted into something much more ambitious, an internet-based application meant to address what the husband perceived as the overwhelming use of internet pornography. He said the perception was rooted in his early industry experience and was reinforced by surveys and published research he read about the addiction. Over time, the app cycled through names, but the court settled on calling it Self Changer. The Self Changer story is full of starts and stops, and the court treats those pauses as part of the businesslike character rather than proof of a hobby. The opinion says he spent considerable time and money in 2015 and 2016 trying to develop and monetize it, including hiring people experienced with TensorFlow and machine learning to build software that could read psychological interviews and generate responsive therapeutic scripts. Then he stopped in 2016 because he believed the technology was not advanced enough to make the automated therapy interactions work smoothly. In 2017, the opinion says he was not actively pursuing it. In 2018, he re-engaged, funding it with wages, proceeds from selling the Massachusetts home, and retirement savings, and tried to simplify the approach by drafting content manually instead of relying on machine learning. The court's profit motive analysis leans heavily on what it sees as real business behavior. It notes the company kept a general ledger and a separate bank account, even though there was some commingling and occasional personal credit card use. It highlights that the husband created a business plan in 2019 with thoughts on market scope, methods, and a marketing to monetize strategy, complete with surveys and financial projects. It notes that he bought advertising space on popular pornography websites to drive traffic to the application. And in March 2019, the company hired its first employee to help develop the app. Someone with sociology degree who worked with him on surveys and content, and who was paid roughly $10,000 in wages that year. The big punchline, though, is that none of this generated income from 2013 to 2019, so the court is evaluating intent under pressure, not celebrating results. Then the plot widens into Maine, with a land development plan that sounds like a dream and lives like a grind. In or around 2017, the couple began searching for a property along the eastern seaboard to develop a small group of passive homes, described as homes requiring minimal energy and not needing to be connected to the electricity grid. They settled on roughly 51-acre lot in Lincoln, Maine, drawn by its size, price, access to Boston, and frontage on Route 1. The purchase structure matters. The lot was already split into two parcels, one about 47 acres and the other roughly 3.8 acres. On October 13, 2017, they agreed personally and through company to buy the whole thing for about $300,000 subject to contingencies. Two deeds were executed on December 27, 2017, and the closing happened on February 8, 2018. Each parcel was bought for about $150,000, and they took out mortgage using the lot as collateral. They didn't just buy land. In December 2017, they bought heavy equipment, a bobcat excavator and a track loader, and received training specific to the machines. They also bought shipping containers for use in the development. And the opinion notes that before moving to Maine, they used those containers to store personal items. They did due diligence too, hiring an engineering firm to assess wetlands and septic locations and obtaining a highway entrance permit waiver from the Maine Department of Transportation on December 17, 2017. The court also emphasizes that they research rules and regulations and maintain good relationship with the town officials to stay compliant with local bylaws. But the human part is what makes a story stick. The opinion says they devoted most of the husband's salary to development, drew from retirement savings, and skipped leisure spending to keep funding the project. They worked weekends on the property, then moved there full-time in August 2018. And the living conditions were blunt. The court describes a Spartan existence, where they slept in a pop-up tent with an electric blanket and used nearby YMCA for bathrooms and shower facilities. In spring 2019, they upgraded to a more robust tent with basic amenities, and then the opinion states they lived in a tent year-round from June 2019 until January 2025. If you're trying to persuade a judge you're serious about a profit-driven project, we live in a tent for years is a memorable evidence. The land itself becomes two different characters. The smaller 3.8-acre parcel owned by the company is where the couple lived. In April 2018, the husband filed a land use application describing a proposed residence, a barn, and 6 temporary storage units. And the application indicated it was not a commercial building. The wastewater paperwork described a system for a 4-bedroom, single-family dwelling. The opinion says he viewed that residence and barn project as a temporary reprieve from living in camp. But rising building materials prices made it financially impossible, so it never got built. The couple continued residing on that parcel until they moved in January 2025. The larger 47-acre parcel is where the sweat went. The opinion says the wife led the effort, operating bobcat equipment to clear land, mulch trees, build access roads, dig trenches, install septic system, and clear debris. Nearly every day, including birthdays, anniversaries, and holidays, sometimes working over 10 hours a day. She joined the Maine Forestry Owners Association for information specific to local forestry conditions. They planned an office for the company on that parcel, and while it wasn't built until 2019, the opinion says the husband designed it using 2 modified shipping containers, got permits, and moved the company into it in early 2020. The passive homes never materialized, but their efforts culminated in access road, and the opinion notes that in January 2025 they sold 47-acre parcel for about $565,000. Now we get to the third thread, the one that snaps. In 2019, the wife decided to use the excavator to operate a landscaping and mulching business under the name Leafcutter. It wasn't a separate entity, just a name. She didn't track her time on it. The husband handled the finances and maintained general ledger. Leafcutter used the company's tax identification number and bank accounts, and the opinion says the activities attributable to Leafcutter consisted exclusively of forestry management and development, including mulching business. After a couple of safety-related incidents, the couple decided the mulching attachment was unsafe and abandoned the venture. On the tax reporting, the numbers land like a drumbeat. For each year at issue, they filed a Schedule C for the company and reported total expenses of roughly $307,000 in 2017, about $175,000 in 2018, and roughly $95,000 in 2019. Separately, they filed a 2019 Schedule C for Leafcutter, reporting approximately $88,000 of expenses, spread across categories like contract labor, insurance, interest, supplies, utilities, and other items. And here's where the court story framing matters. This trial was only about for-profit intent. The opinion explicitly says the substantiation and penalty would be handled later, to the extent necessary, and that the trial in this phase was only on whether activities were engaged in for profit. So, what did the judge do with all of this? The court breaks the activities apart instead of treating them as one blended enterprise. It says the software development, home construction, and mulching were predominantly separate, with only minimal interconnectivity, beyond some commingled funds and shared equipment. Then it applies the profit motive factors and calls it a closed case. The software development effort wins. The court holds the couple engaged in software development activities for profit for years at issue, pointing to business-like actions like a business plan, surveys, hiring help, and running ads, plus the willingness to change strategies and even shelf development when it didn't look commercially viable. The real estate piece is split down the middle. The court holds there was a profit motive for developing 47-acre parcel, but not for the 3.8-acre parcel. In plain English, The big parcel looks like development work aimed at value and eventual sale, while the small parcel looks like a place to live. The court points to the documentary evidence. The applications for the smaller parcel describe a residence and a system for single-family home, not a commercial or multi-home development. The opinion also leans on reality that they treated the smaller parcel as their primary residence during much of the years at issue. Then comes leaf cutter, and the court doesn't hedge. It says it readily finds the couple failed to prove the mulching business was engaged in for profit. The wife testified that the biggest difference between leaf cutter and their own land work was that she'd be doing work for clients' pay and she did tree removal for others. The court says the assertion is unsupported by the documentary evidence, and it's built by the fact they reported no income but significant expenses, and that she didn't record her time. She testified she spent about 50 hours per week on leaf cutter, but the court says it doesn't find this part of the testimony credible, given how much time spouses were putting into development of the land during the same period. So on leaf cutter, the IRS wins. The court sustains the disallowance of deductions on that 2019 leaf cutter Schedule C. Finally, the opinion lands on practical allocation problem. Because expenses and effort were commingled between the two parcels and the records keeping didn't clearly track what related to which parcel, the court refuses to allocate simply by acreage because it would be improper and arbitrary. It starts with the land area as reference point, notes the smaller parcel is about 7.5% of the total, then makes what it calls a special allocation that weights the heavy personal use of the smaller parcel and the lack of records heavily against them. The result is blunt split. The court allocates 25% of total home construction expenses to the non-profit motive, 3.8 acre parcel, and 75% of the profit motive to 47 acre parcel, with deductions allowed to the extent later substantiated. And that's the story, real thing. Not whether the work was real, it clearly was, but whether the purpose was profit and whether the documents match the narration. In this case, court basically says the app effort looked like a business trying to become a business. The big parcel looked like a development effort that ultimately produced a profitable sale. The small parcel looked like a home base. The leaf cutter looked like a label stuck onto the same forestry and development work without credible proof of paying customers. You could call it the tax court's version of I believe you, except when you say you run a mulching business for clients because the paperwork and the numbers are telling a different story. My name is Alex Dvorkin. I'm a certified public accountant in the state of California. If you like this video and found this information useful, please like this video and subscribe to the channel. And I'll see you in the next tax court case review.